Have you ever paid for a purchase with cash and received the wrong amount of change? Maybe got back too much money or not enough. While these mistakes may seem minor, they happen every day in businesses that accept cash payments. Handling cash creates unique challenges. Cashiers may make errors when giving change, counting drawers, or recording transactions. Businesses must also invest time and resources into safeguarding cash, including employee bonding, cash counts, deposits, and security procedures. These are just some of the reasons why companies encourage customers to use electronic payment methods instead. However, cash remains an important part of many businesses, and when the amount of cash in a register doesn't match what the accounting records say should be there, accountants need a way to record and track the difference. In this video, we'll explore the cash over and short account, learn why cash differences occur, and see how accountants properly record transactions when there is either too much cash or too little cash on hand. In businesses that accept cash, mistakes occasionally happen when cashiers make change. These errors can result from distractions, a busy work environment, inexperience, carelessness, or simple human error. When the cash drawer is counted at the end of a shift, there are three possible outcomes. The amount of cash in the register may be exactly what is expected, greater than expected, or less than expected. If the amount counted matches the exact balance, no adjustment is necessary. However, if the actual cash exceeds the expected amount, the cash is considered over. If the actual cash is less than the expected amount, the cash is considered short. In practice, cash shortages tend to occur more frequently than cash overages because customers are more likely to notice and report receiving too little change than receiving too much. Regardless of whether the difference is an overage or a shortage, accountants record the amount in the same general ledger account called cash, short, and over. Businesses should also monitor which employees experience frequent cash shortages or overages. A pattern of discrepancies may indicate a need for additional training, process improvements, or further investigation. By tracking these differences, management can identify problems early and improve the accuracy of cash handling procedures. Here's an example for Chrissy's Cupcake Creations, a retail business that started on June 25th. It keeps a $300 change fund in its register, and so that means that the company always has a $300 in the register, and the cashier starts with $300 in the morning. Then at the end of the day, after the sales money for the day has been deposited, there should still be $300 in the cash register. So let's look at the first transaction. The cash sales for the day per the cash register tape were $1,237. And the cashier counted $1,531 in the register at the end of the day. Our goal is to figure out whether the cashier has the correct amount of money for the day. We start with the information that we have. The change fund is $300. Cash sales per the cash register tape is $1,237, and the cash count is $1,531, which includes the change fund. We subtract the change fund of $300 from the cash count because the change fund was there when the cashier started, and the change fund needs to remain in the register. Now, an important step for the cashier is to count the change fund at the beginning of the shift so that the cashier verifies that they truly received the correct amount. So again, we subtract the change fund of $300 from the cash count of $1,531 at the end of the day. Now, our example for June 25th, that leaves us with $1,231 that the business is going to deposit in the bank account. Now we're going to compare what the business is going to deposit of $1,231 with the sales of the day of $1,237, and we find that the deposit is less than the sales by $6. In other words, we have less cash than we should have had. So what do we do now? How do we record our general journal entry? Well, let's start with what we know and enter the date and then the account cash into the description. We know how much cash we deposited. It was $1,231. We'll write that amount into the debit column of the general journal. On the next line, we enter the GL cash over short into the description column. And when the business has a cash shortage, it's an additional expense of the business. Maybe you're wondering why we don't just record the cash deposit as sales. The reason is that the business wants to show accurate sales. For one, that the sales account on the income statement has to match the sales register. In addition, businesses want to track to what extent cash shortages or overages impact the business. So again, when the business has a cash shortage, it's like an additional expense of the business. And we record that with a debit. On the next line, we indent slightly and write sales into the description column and the amount of $1,237 into the credit column. This is the amount from the sales register tape. Now, if you're struggling with this journal entry, start by writing the cash line first and the amount that was deposited. Then leave a blank line and write the sales from the sales register tape on the third line. Then compare the debit and the credit and decide where the cash shortage or over should be debited or credited. After all, both sides of debits and credits must balance. Let's look at the second transaction that occurred on June 26th. We start with the information that we have. Change fund is $300, cash per sales register tape is $1,350, and the cash account is $1,642, which includes the change fund. We then subtract the change fund of $300 from the cash count at the end of the day. In our example for June 26, that leaves us with the amount of $1,342 that the business is going to deposit into the bank account. Next, we compare what the business is going to deposit of $1,342 with the sales for the day of $1,350, and we find that the deposit is less than the sales by $8. In other words, we have less cash than we should have had. That means it's like an expense of the business. We're now ready to record the journal entry by debiting cash on the first line for $1,342, debiting cash short over on the second line for $8, and crediting sales for $1,350. Now let's look at next at an example with a cash overage. The third transaction occurred on June 27th, where we had cash sales of $1,358 and a cash count of $1,663, which includes the $300 change fund. We start by subtracting the change fund of $300 from the cash count at the end of the day, and in our example for June 27th, that leaves us with the amount of $1,363 that the business is going to deposit in the bank account. Now we're going to compare what the business is going to deposit of $1,363 with the sales for the day of $1,358. And we find that the deposit is more than the sales by $5. In other words, we have more cash than we should have had based on the sales register tape. A cash overage is like a contra expense. It is credited to the cash over short account. We're now going to record the journal entry by debiting cash for $1,363 on the first line. On the second line, we slightly indent, credit cash over short for $5. And on the third line, we credit the sales account for $1,358. Cash shortages and overages are a normal part of operating a business that accepts cash. While individual differences may be small, they can add up over time and may indicate errors, training issues, or even fraud. By using the cash over and short account, accounts can accurately record these differences and help management monitor cash handling performance. Understanding how to account for cash discrepancies is another important step toward maintaining accurate financial records and protecting one of a company's most valuable assets, it's cash.